50 basis points. The Federal Reserve has just cut at a rate that we only see usually during recessions. So in 2024, is this time different? In today's video, we take a look at what it really means and whether it's as terrifying as some people might suspect. We also need to talk about dark pool activity. There were plenty of massive trades at resistance levels that were hit on the NASDAQ, Russell 2000, and of course, rejections on the S&P 500. So with certain stocks breaking out in a massive way when positive gamma takes over, now we're leading into the OPEX. Could we be seeing gap fills just around the corner? Stocks, commodities, and cryptos, this one is not to be missed. See you on the other side. Well, welcome back everyone to The Daily Show. My name's Tom, and what a day of green it was, with many markets absolutely ripping higher, including big tech, and of course that one we've been discussing for quite some time. In our private community, we discussed Tesla during the start of the session, and we thought it was going to rip. Little did we know it was going to go so strongly with the positive gamma move. So let's have a look now at the sentiment results. Well, as it turns out, sentiment seems to be shifting again towards the bullish end. And this has some people a little bit worried about this move. Is it a false move? Are we at resistance? The dark pool activity actually went ballistic over the last 24 hours, which could be very telling. So 50.8% of respondents went to the bull end, 26.4% to the bear end, and the rest were neutral. It's important to note that this particular result was before the overall FOMC event, but we do know that bull-bear spread went back up, getting closer towards that 30% threshold. And this is where we've often got to be worried about a potential kind of sell-off from these events. And it brings us back into that thing that we've been talking about, the kangaroo-style market. Yes, we're at an all-time high on the S&P 500, but that doesn't mean that October won't be volatile and that the next 1 month in particular to 2 months of market structure needs to be paid attention to. Here are some interesting stats. This one we posted over on our X, links in the description down below. And we also shared another stat that we've talked about in the videos before in our weekly newsletter. Sign up in the links down below for that as well. Completely free to do so. We sent that out yesterday, so you should have got a copy of it. JP Morgan, in the last 40 years, the Fed has cut rates 12 times, with the S&P 500 within 1% of its all-time highs, similar to this point. The market was higher 12 of 12 times 1 year later, with an average gain of 15%. Now, as a couple of you did mention, yes, but this time we've done 50 basis points. And this is a very interesting thesis because, of course, we've talked about on this channel before that if a 50 basis point cut was to happen, that maybe we need to be terrified. Now, you'll notice a few weeks ago, or maybe about a week ago, I started to modify that based on what the market was actually doing. The market was coming in strong, the market was coming into a higher level, and it did start to read into a lot of these stats, such as the one we just saw. A topsy-turvy kangaroo-style market with a chance of it actually having a 12-month decently positive run. And again, this Ryan Detrick chart here shows us that overall, the first month is the one to be watching. 45% of the time after we get some form of rate cut, we usually see up, down, and all around. And it means that probably none of us really have to have too much FOMO in the markets now. Statistically, there's a good chance, at least a coin flip, that markets will potentially come back down. And even when they were up over that session, it wasn't like they were absolutely running away unless you look at 1985. So because we've now had one of the largest gaps that we've ever seen since COVID, and that was a massive gap up over the last 24 hours, we know that there is a good chance that markets will come back at some point over the next kind of 30 days. So first up, I guess one of the things we want to mention in this video was I don't think it's a time to have extreme FOMO. However, we also need to ask ourselves the question of, are we going to see a mega crash happening in the next 1 to 3 months based on a 50 basis point cut? Is that a real pivot by the Fed that's freaking out? Well, one of the things that we know is that the Federal Reserve likes to stay around 2% above the inflation rate generally. In this case, because they've now said, you know what, we beat inflation, don't worry about it. By the way, we don't believe they've beaten inflation here at FX Evolution, but they do. They're going to claim it anyway. And it will inflate again, we believe, in 2025 in particular. This is something that they've now done. They've said, we've got to focus on our dual mandate, but stuff the inflation story. Let's move over to the job story. And they clearly see a weakness there, which they're trying to plug the hole on. Now, you could argue this 50 basis points is election-based. You could argue that this 50 basis points is based on the fact that they're freaking out. Or you could even say that they should have already cut about 2 or 3 months ago, and therefore they're trying to play catch-up and saying, hey guys, the Fed is here. Ultimately, it doesn't really matter. The market's going to show us the story in the charts, and it's something we've really said here on the channel quite a few times. I did read some of your comments, and obviously a lot of you were talking about the idea of, you said 50 basis points was going to be terrifying. And yeah, I do think it is a little bit terrifying. Remember, we do believe that we're 21 to 22 months into a bull market cycle. Now, if you think about that, that's actually getting on. That's getting into the late cycle component, which we've been arguing here on FX Evolution for over 6 months now. And we've been talking about gold and utilities doing quite well over that next 1 to 2 year period. And that's the thing. Late cycle can go for a while. In fact, this is part of what we believe is a larger debt cycling inside of the markets. And it leads us to kind of say, well, wait a second, could we go heavier and still longer in the markets till 2025? At the moment of our main reads, in terms of bearish reads, we're not seeing enough signs. We've got the uninversion of the yield curve, but we still have some of these things. The breadth of the market is still quite strong. Take a look here at Grant Hawkridge's charts, and this is what we've got in the background, which basically shows us here that some markets are doing pretty well. Basic materials started to ramp, as we saw on this channel, before the event itself. Now, that's showing you that the market's probably starting to sniff out this possibility of reinflation story. Financials are also doing very nicely, as are REITs and certain other markets. So what this is showing you is that basically at the moment, the markets are not terrified enough. They're not scared, and the structure looks like it's still bullish intact. And this still leads into what we've talked about. 21 months, 22 months of bull market so far. The average usually goes for 31 months, which pushes us into 2025. At the moment, that's the way you've got to look at these markets. They're bullish until proven otherwise by market structure. And it's possible the next 1 to 3 months can show us that. But for now, of course, the markets are looking from the medium to maybe 1 year away relatively bullish. Why? Because the street is basically saying we want to buy up. It's going to come back to earnings. Earnings is only a month away. Make sure to subscribe to the channel. We'll be covering it in great detail. And of course, we know that at the moment, all of these main economists are upgrading the markets. We also know that at the moment, the market is pricing in somewhere between a recession and a non-recessionary path by the Federal Reserve. We already have the dot plot, and the dot plot basically says the Fed's going to cut a few times into 2025, and then they're going to kind of get a terminal rate somewhere between 3 and 3.5%. And that if they beat inflation, that's going to be good. I personally think it's going to be something like the 1970s, where we're going to continue to see the Federal Reserve go with the cut cycle. They're going to get reinflation in the economy, and they're going to say, oh, whoops, we made a mistake, but it's going to be too late. And that's where the problem probably lies. But we'll explore that more in the future. Remember, another story is going to be, we need to see everyone celebrate the soft landing. Now, at the moment, 79% of respondents believe that we are in a soft landing, but we need the celebration. And we do not have the celebration just yet because we've only just seen rate cuts. So these are all interesting components when it comes to the data and the things that we're seeing. If we are to follow similar paths, though, of non-recessionary next 12 months, the Russell 2000 could be one of the places to be. And of course, people like Fundstrat's Tom Lee are very bullish on that particular market, and it's coming up to a critical resistance, which if it does break, could really explode that particular market overall. Over the main areas, we need the 493 other stocks to also improve, and of course, market structure will be all important. And we'll notice here that when it comes to no recessions, we usually see the markets actually ripping higher after being in a bit of a kangaroo style around the cut. So we may still see a sell over the next week. It's very possible, maybe even 2 to 3 week period. And then if we end up going into the bull end, good news for the bulls. And if we start to make structure that looks more like this orange line, bad news for the bulls. Very good news for the bears out there. So really follow the price action, follow the structure, and remember what we've always said. You've got to have the patience in these markets. Median 2-week returns, we know the next weeks could be, of course, volatile now that we're in the last 2 weeks of September. And this is usually how seasonality works. However, if you cut the data and you actually look at a US election, it can often be like this. Kangaroo style in overall action. So of course, we may not be as negative as we could have been in September, but don't discount October. October often sees incredible volatility, and remember the vol structure of the VIX this year also looks towards that. And this is coming directly from data from people like Tom Lee and others that have been relatively correct over the last couple of years. Equity also is not quite up there with the global leverage. We usually want to see leverage at a higher level. It's not at those super dangerous points that you would suspect with an epic crash just around the corner. That's just one read. And as some of you in the comments, and yes, I did read the comments yesterday, some of you quite angry. Fair enough too. I understand what you're saying. But remember, just one data point is not enough. Never make your decision off one, guys. Make your decision off many data points and build a complement story. In our advanced course that we do offer, yes, it's a plug for it, I go through the cyclical history. I go through all of the different reasons why you might want to be bullish or bearish during certain times on the larger scale. And that's because it's based on more than one data point. It's a building of confluence of a storyline. And it's very important you have confluence and, more importantly, confidence in those levels. So the level that we just hit on the NASDAQ will be important. We've, of course, seen the advanced decline lines going up. We've obviously hit the resistance here, and we've seen some large dark pool transactions. So just before we go through that, let's have a look at some other reads. 3% decline 2 weeks ago to 3% rally. Not exactly a negative stat that comes off that according to Jason Gopford over on X. But also we see S&P 500 forward returns, whether it's a fast or a slow cut, ends up kind of being a little bit volatile around these times. Now we've shot off in the positive direction. We've gapped up, one of the biggest gaps we've ever seen. Will we now come off? Well, dark pools, certainly we're going. We'll see that in a moment. But these are the cyclical structures we have to follow. And we, at this stage, still believe we could be in a 98 or 2019 style structure. We'll be proven this by the market very soon. But let's talk dark pool activity, because something synced in the markets over the last 24 hours, which I found very telling. And that was semiconductors. Semiconductors smashed into the number one area of transaction that we saw over the last year. And guess what? They sold directly off the gap fill. This was something I was looking for before the FOMC. We were all looking for it together, but now we've seen it. Could this be a resistance? Look at these transactions, huge transactions straight into the close on the Qs over the last 24 hours. Huge transactions coming in on the S&P, the SPY to be the least. And then of course, we also have some transactions that came in phantom style right in that close, right at the end. So this means that there are large transactions coming in right at the end after that huge move up. Could that expose gap fills? Could that expose the kind of stats towards the negative side? Well, I'm not sure I'm super won over by this rally. And I think one thing here is that you don't want to have necessarily too much FOMO. But you also need to consider this structure. Let's look at the structure. Semiconductors up over the last 24 hours, 4.34%, smashing into that gap fill. Metals ramping up, certainly one of the areas that we've been in pretty heavily. And then, of course, when you look at the last 5 days, regional banks absolutely blitzing this cut because now they're not feeling the financial stress. Remember, the Fed has basically said, oh yeah, we're going to cut now. We're going to cut, and we're going to claim that we're in soft landing. It's all great. Remember, we don't actually believe it's going to be great, but timing will be everything. It's very important. Do I think 50 basis points is an overreaction? Potentially. Do they know something about the labor that we don't know? Maybe. But the market structure will be our guide in this case. And at the moment, of course, we've seen that ramp, and you've got to think of it more as just not one day, but multiple days over. And I know it sounds like I'm ranting a little bit in this video, but the reason why is I did see your comments. I want to kind of make it clear to a few of you that had some pretty strong things to say. And the reason is purely just because I want to let you understand that, yes, I thought 50 basis points was bad. All the data points towards that. But you've got to consider where we're seeing the 50 basis points. We're not seeing it where we traditionally would. And you might say, what about 2000s? You're ignoring 2000s. Go and have a look at when we saw the cut there. Think about the bubble that we were coming in with. Think about the structure that we were coming in with, which was really just one market ramping off. And you might say, well, AI is the same. But we've got this strong underlying demand. I think it's very important to consider that. So advanced decline line has come through. We've obviously started to get some reads of overbought markets. It's possible that the market may stay up for a couple more sessions. But one thing's for sure, large transactions came through. And we've been really looking for transactions of this size. Now, this looked like a really negative candle. So, of course, to blitz that will have put a lot of pressure on people. And that's why if you were to go short here, you should have been using at a minimum a 2-week option. And the reason why is because realistically, you could have to expect very sneaky shenanigans going on from the markets. The trend is still up. The series is, of course, a bunch of higher highs and higher lows. But let's have a look at the futures market action. If you're a day trader, you'll be watching the 56.86 level from a bear side. If it breaks past that, could expose shorts. And of course, the 56.06 remains the key level to push towards a 5,500. As most of you know, though, we knew we were moving into positive gamma if we broke through 56.40, and that's exactly what happened. The market went absolutely blitzing up and is still exposed during this OPEX towards 57.40 to even 57.50. You can see here where all the calls are expiring over the next 24 hours, and it's very much on the positive gamma side. So it could stay up here. It's certainly possible, and I wouldn't actually mind for it to stay up here, read a few more times at these highs, maybe allow Tesla and some other stocks to get even more crazy. And then, of course, it could potentially come down. When we look through to the next week, we can see here again, 57.40, 57.50, 5700, lots and lots of calls on that. And this will probably be the defined resistance level for now, unless we're able to break through it and continue up further. But those big transactions have us saying, wait a second, look, instead of going with the big flow on the indices, maybe you want to be saying, maybe I want to buy some of these underperformance stocks that are now breaking out to the upside, because those stocks are probably going to benefit from the cut, at least initially from market sentiment. Let's have a look at the CTAs here. I just put silver in just to show you guys. Again, still was mostly upticking over the last couple of weeks. And then let's have a look at NVDA, because NVDA is trading around 118. Still 120 is a big problem for it. Above 120, probably move on to that 124-ish gap level. But if we move over to Tesla, this was the big story of the day. That's a good trade. Any of you guys get this trade? Let us know in the comments down below. But as it blitzed through into the pre-market, it just got stronger and stronger and stronger. And this was a classic case of positive gamma taking over. We knew that when we broke 230, it opens up the 250 level. Obviously, 240 is a big key here for the Friday close, but 250 becomes next week's, and it could even ramp into the 280s if this continues to get more wild. And that's probably against the sentiment. A lot of people would probably be saying, oh, Tesla's cooked, Tesla's done, Tesla's finished. But ultimately, the price action comes through. That's why we have to put our opinions at the side and trade the price action whenever possible. Let's take a look at the VIX. The VIX was, of course, down 16.34, so it dropped off in volatility. And the US dollar got to a level where I would have thought we would have found some bid. Right around in here was where I'd be looking for bid on the dollar, and that's to be determined whether it can find bid. Some interesting shenanigans going on after, of course, the FOMC event, which pushed up in a big way. And I think from a replicable standpoint, I could make a case for the dollar to find some bullish moves here. But of course, if it does end up closing the week underneath our important line, this will then expose 99.50. And I think it becomes bearish. So what an important 24 hours here for the dollar, especially from the day traders versus the larger swings. Now, because the dollar's weak, some of our other markets have done very well. Copper in particular, beautiful stuff. Congratulations. Absolute replication trade. And that's what you're looking for. Who cares what everyone has to say? You find the replication and you trade the replication. You trade your edge in the markets. Don't go and cowboy into a bunch of positions because somebody else says, oh, it's undervalued or not. As a trader anyway, you should be looking for statistics and looking for edge and looking for replications. It's a business after all. That's what you're trying to do. So this just shows you again the types of movements that we look for and of course how it's kind of against many people in the market. For 54.60 ideally would be where copper moves to, and it does show the potential of a greater storyline here. Iron ore in a descending channel. Could this be also turning around? What does this have in terms of implications for China? We've seen HSI absolutely blitz it off a replication level as well. US oil also on the improve. Will it get to 74 a barrel? I think that pullbacks such as levels to like $70 could actually end up into $74. It looks like at the moment oil has been on the improvement since we spoke about it only a week and a half ago. Gold's also pushing higher. Of course, we believe it's pushing much higher because if over the next 6 months to even 12 months, we think gold's getting towards $3,000, maybe even $3,600 an ounce. And you might say that's nuts, but remember, we've discussed this as a community. A lot of you guys have been doing very nicely off gold since $1,800 an ounce. So we've been talking about this for quite some time. And part of the reason is because the central banks, such as the Federal Reserve, have stuffed the system. Remember, this Fed cut, the 50 basis points, it shows you how they are basically saying, we have your back, market. Don't worry about a thing. The Fed's here to save your ass. And while that's not going to be true into the future because they may cause reinflation, let us know if you believe that, this is what they're telling the market right now. They're saying, yes, we're going to stopgap it. Yes, it's all good. Everything's all good. The labor market's going to improve. Don't you worry about a thing. And you could argue that's political. You could argue that is ridiculous. You could argue that's detrimental to the long-term health of the US economy and world economies. And I would say that especially on their long-term health, it is detrimental. But when we look at it, what is this telling us? It's telling us silver, gold, and some alternative assets might do better over the next 6 to 12 months during this cutting cycle. In particular, we've seen silver press our first TP zone. And just to show you how good your zones are, guys, look at the angles here on this particular area. We did this weeks ago. We talked about this level. And this just shows you when you're great at working out your levels, how markets interact with those areas. And that should give you a lot of confidence that price action compared to the narrative is where it's at. Now, if we break through 3150, will that be a huge deal for silver? I believe so. We'll be watching it together. And you can see here that regardless of the rate cut, which usually does end up leading into silver doing better, we'll be looking for that 3150 to break through. Now let's talk Tesla. This was an interesting one. A double tweezer action on the short, followed by a strong market action during the day. It was pretty clear this one was going to ramp up. And I did mention it in our private market masters. If you join, you can go watch the video. I actually did a little sneaky kind of scalp on it as well, which I don't usually bother doing, but that was, 2 or 3 to 1 or whatever it was, success rate. So generally speaking, what we're looking at is we had a positive gamma level. The market was coming in hot and it was probably going to flow upon itself. So a 244 is a pretty strong move. I'd like to see this thing at least get into the gap fill, which is 246. So you can see there's the gap fill from the previous time. And obviously this exposes 250 and maybe even 280. Inverse head and shoulders, very strong breakout. Hard to be negative on this. And pullbacks you would have to think could be met by bull demand at this stage. So Tesla's on the break at this stage and looks pretty strong. NVDA, on the other hand, pretty crappy, frankly. In fact, I don't want to even talk about NVDA because it was a lot weaker compared to what we thought we might see, which was semis. And semis came in and they smashed that level gap fill that we talked about. Bang, straight into it. Then guess what? Massive transaction occurred right there. Wow. Okay. So is that a sell? I don't know. It's certainly someone taking a bit of profit, and I don't blame them. That's a perfect gap fill and a good level to potentially see some weakness. XLF, XHB, KRE, doesn't matter what you're looking at. All of these markets that you would usually expect to be showing signs of weakness if the market was about to crash tomorrow are not doing it. So again, it suggests that if pullbacks do happen, statistically, it's not too terrifying. Let's have a look at the Chinese market, HSI here, something we've followed for a long time. Replication all over this particular position and a beautiful move to 18,360. A break of this level exposes the potential to go towards 20,000. So it's significant stuff here going on. And again, it's contrary to what people believe. It's not looking good over there. It looks horrible. But overall, the market is still pressing towards the high. Let's move over to the US 2K, hit the second res, struggled around that zone. Weekly close will be important here. Well, we're going to be watching the US 2K a lot because this could actually have a breakout flow on it next week. That was a pretty strong close, although it still went into the res. If we look at the NASDAQ, straight into the resistance, we've called this level for a while a bear bust area because if it gets through this area, it probably pushes 20,420. So at the moment, we're seeing quite strong action, but if we get underneath a level of around 19,300-ish, that's probably going to bring in the bears. So again, some interesting stuff there in good times. What about Bitcoin? We know we're bullish on Bitcoin. I'd like to see it at 64, 65. It's getting very close. We're obviously angling in at this red box here. And if we manage to close above that, 68 will be the next level we look for. And if we get through 68, wow, crypto traders will be big time on this. And I think this is a ramification of the 50 basis point cut. It looks to me like the Federal Reserve is trying to kill the US dollar. And they're trying to take that thing down over the next 6 months. And there are reasons for that we'll discuss in an upcoming video. But Bitcoin for now seems to be ramping, and it looks like it wants to go towards that 64.5, 65K zone. A lot of stuff that we went through here today, guys. I have been reading your comments. I do appreciate even the people that have critical thought process about things. And I understand also one of the things. I did say a few weeks ago, be terrified if they cut 50 basis points. And at the time, yeah, we were down quite a lot, and it obviously was looking bad in structure. But things do change. And in the words of Stanley Druckenmiller, he says, my opinion this week may change next week, and I reserve the right to change it if it's necessary to do so. So guys, thanks so much for watching. Subscribe, smash that like button. And of course, if you're from Melbourne or Sydney, check out our events. I'm going to lock in 30th of October, I believe, for Sydney. So make sure to sign up there before it fills. And Melbourne is getting very close now. So make sure to sign up if you're from Melbourne and you want to come and meet us and obviously have a great day of talking about some pretty serious stuff to do with markets. VIP free weekly newsletter as well. We're putting those out all the way to Christmas, so make sure to sign up for it. If you're interested in finding out more about our replication systems, check us out on the 7-day flash sale, particularly the day trading and advanced masterclass. What a week. You're part of history. Let's see what happens now. The data obviously is interesting, but the dark pool transactions and the big ones that came through, I think they're quite telling. And we're going to be looking for market structure together. Bye for now.